I would now like to review with you problem 2111 in your textbook, and it is to complete the entire statement of cash flows using the direct method. And we get our information from the balance sheet, the change in the balance sheet items for the assets, liabilities, and equity. And we get it from the current year, 2021. We actually get that information from the income statement. You're very familiar with the cash flows from customers, from investment revenue, and from sale of cash equivalents. Now, for me to review that with you, I have to go through and analyze other accounts. Now, from customers, you would be able to do that fine. If you have any questions, please email or text me. For investment revenue and from sale of cash equivalents, I will explain that as we either gather information or some of the change will incur a couple different accounts. Now, as far as the cash outflows that we've worked on, and you will give assignments to calculate cash outflows to suppliers, to employees, for insurance, but I'll go over interest and income tax with you. We haven't done much practice of this calculation during the previous and following videos I made for you. So for interest, we're going to go to the income statement, and the entire interest expense is $28. And there's an interest payable. The interest payable was increased by $4. And the discount on notes payable was decreased by $3, so it's a credit. So the cash from interest outflows is subtracted at $21. And the same thing for income tax. I went to the income statement, and the income tax expense was $36. There was an increase in deferred tax liability, which is a credit of $3. There's a debit to income tax payable because that was a decrease. So the cash outlay for income tax is $35. I would now like to review the next section of the cash flow statement, which is cash flows from investing, and the accounts that have to be analyzed in the cash flow from investing is your long-term assets. Examples that are shown right on the Excel sheet and pertain to the company was equipment, long-term investments, and purchase of land. I encourage you to not just think of the accounts that have to be looked at are not limited to equipment, long-term investments, and land. You would have to do and analyze all other long-term assets. So let's first look at the sale of equipment. The sale of equipment gives us additional information in section C, and it says equipment was originally costing $70 million that was 1/2 depreciated, was rendered unusable by a flood. Most major components of the equipment were unharmed and were sold for $17 million. Well, first I suggest you set up a T account. The beginning balance for equipment is $400. The ending balance is $412. Now, based on the information given to us in section C, the equipment should be credited for $70. The accumulated depreciation is 1/2 of the total cost, so you would debit accumulated depreciation for $35. And you can look at your income statement and you will see there is a loss from the sale of equipment of $18. So the actual cash we received was $17. The cash we received was $17. Now, I'm going to skip investments for now, and we'll come back to that. But I do want to go to the purchase of land. I will now like to go over the purchase of land, and to do so, refer to F, please, for additional information. Land costing $46 million was acquired by issuing $23 million in cash and a 15% 4-year $23 million notes payable to the seller. So we can analyze our land, and we go and compare the land on the balance sheet, and you will see that the land did increase $46 million or $46. Okay, of that $46, what did they pay? Cash of $23. So that's what the net cash outflow for the investment in land is, $23. But they also issued what? A new notes payable for $23 million. In this example, we have a partial non-cash transaction. And you can see at the end, for non-cash investing and financial disclosures, at the end or the bottom of the cash flow statement, they are noted that the company did acquire $46 million of land. However, the cash paid was $23 million, and the actual cash paid was $23 million, so the notes issued would be $23 million. I will now like to review with you the third section of the cash flows, which is the cash flows from financing. And the financing needs to be examined by analyzing the long-term liabilities and the stockholders' equity. Let's look at G, an additional information given to us. The right to use a building was acquired with 15-year lease agreement. Present value for the lease payments was $82 million. Annual lease payments of $7 million are paid at the beginning of each year, starting on January 1st, 2021. We know the right to use asset is a long-term asset because it is part of the equipment. And if you look at our analysis for equipment, the full value of the lease is recorded at $82 million. So when we take the beginning balance of $400 million and the $70 million worth of assets removed from the books and add the $82 million right to use asset, it does balance our equipment account. It's very important to know that your accounts balance based on the work you perform in the cash flows. Now, the payment of the lease at the beginning of the year was $7 million. So that's the cash that was paid. So that's where we have the $7 million. Now, let's go to H. 60 million bonds were retired at maturity. We can go and see, if you go up to the balance sheet, you can see there was bonds matured, because the beginning balance of the year was $275. Now it's $215. That's 60. So that, in fact, is balanced. You can also examine the lease payable. The lease payable, the actual present value of the lease payments were $82 million, and they made their first payment in January 1, so 82 million minus 7 shows you the lease payable is now balanced at $75 million. Now, the next thing we could go over is the sale of preferred stock, and you can see in E, the sale of preferred stock was sold at $25 million. Excuse me, when I went through the sale of preferred stock, I really looked at the preferred stock of Troy Corporation was purchased by the company, so the $25 million is incorrect. If you go to the analysis of preferred stock in the equity section of the balance sheet, you can see that preferred stock at the beginning of the year was 0, and at the end of the year, it was $75 million. I would also like to point out to you in April, 1 million shares of common stock was repurchased as treasury stock at a cost of $9 million. So you can see that the treasury stock is a cash outlay of $9 million. Now we're going to go back and visit some of the more difficult and new transactions. And the first one we're going to look at is A. Investment revenue includes Arduous Company's $6 million share of the net income of Demure Company and equity method investee. Under the equity method, to record an investment, for the purchase price, you debit the long-term investment and credit the cash. But for the company's share of income, in this example, Arduous Company's share of the Demure Company would have been $6 million, and they would debit long-term investment of $6 million for Arduous share of the company's percent ownership of the net income. And you can see there's a debit to long-term investment there. And our long-term investment now is balanced at $156 million. So now we can analyze the cash from investment. And when we go to B, we can see that the treasury bills were sold in 2021 at a gain of $2 million. Arduous Company classifies its investment in treasury bills as cash equivalent. Because they actually treat treasury shares as cash equivalents, then the actual gain of $2 million is shown as a cash inflow from sale of cash equivalent of $2 million. Now, we have to look at the investment income or investment revenue, which is $11 million. So how do we calculate what the cash flow is from investment revenue? Well, we know our investment revenue is credited for $11 million. We know the long-term investment was debited for $6 million because of their investment in Demure Company. It was the share of their profits. And if you look at the balance sheet in the current assets section, you see investment revenue receivable, and that was increased by $2 million. So to balance our cash from investment revenue, we have $3 million in cash. The last thing we have to do is analyze retained earnings for the company, and the balance of retained earnings at the beginning of the year is 227. At the end of the year, it's 242. So, where did we get the debit for retained earnings of 30? In section they gave us information. In February, Arduous issued a 5% stock dividend, which is considered a small stock dividend of $4 million for 4 million shares. The market price was 4 and the market value was 7.5. So if you take the 4 million times 7.5, you have a debit to retained earnings for that transaction of 30 million, common stock at par at 20 million, and paid in capital of excess of par at 10 million. The increase in retained earnings is $67 million. That's for the net income. So right now, you know you have to balance the 227 and plus 67 minus 30 to 242. That means we infer that the difference is a $22 million dividend paid. And if you go up to the cash flow from financing, you can see the $22 million paid.